Welcome back to Synaptic Dividends. We're always breaking down new dividend stocks to help you build out that passive income portfolio. So if that's your goal, you're going to want to make sure you're subscribed so you don't miss a thing. All right, today we are diving into a retail giant, Target. I mean, we all know that iconic red Bullseye, right? It's the staple for millions. But the big question for us as dividend investors is this: is it a Bullseye investment or is it actually missing the mark? To figure that out, we've got to cut through all the noise and just look at the hard numbers. So, let's start with the single most important question you can possibly ask about any dividend stock. Is it actually affordable? This is what we call the cash flow test, and it tells us if that dividend is truly safe for the long haul. To figure this out, we use a metric called the free cash flow payout ratio. Now, I know, that sounds a little jargony, but stick with me, it's actually super simple. Think about it like your own personal budget. It's basically the percentage of your actual after-tax take-home pay that you spend on one single bill. For a company, it's the percentage of their real cash profit they use to pay out the dividend. And you guessed it, just like with your budget, a lower number is always safer. So what's Target's number? Well, right now, it is sitting at a really healthy 45.7%. That is a very comfortable level. What this means is that after all the bills are paid, after they reinvest in the business, the dividend only uses up less than half of the cash that's left over. That leaves a huge cushion, a massive margin of safety. But this is where the story gets really interesting, because you can see how this holds up under a real-world stress test. Just look at that column for fiscal year 2022. Whoa, free cash flow went negative. So what happened? Well, this was caused by a big inventory problem that they had to fix, and it just temporarily torched their cash. But here's the most important part. Look at the rebound in 2023. Cash flow came roaring back. This tells us two critical things. First, that 2022 issue was just a temporary blip, not some deep, fundamental crack in the business. And second, it shows that management can spot a problem and fix it fast. The underlying business is clearly very resilient. Okay, so the dividend is safe. Check. It passes the test, it's affordable, it's resilient. So now let's move on to the second critical question. Does it actually have a history of meaningful growth? And the answer to that is a huge, emphatic yes. Target has increased its dividend for 53 consecutive years. You know what that means? That puts it on this ultra-exclusive list of Dividend Kings, companies that have raised their dividend for more than half a century. That is just an incredible track record. And we're not talking about tiny, microscopic increases here either. Over the past decade, that dividend has grown at an average annual clip of almost 9%. Growth like that has seriously outpaced inflation, which means your passive income stream as a shareholder has actually grown in real-world purchasing power year after year. And this right here, this just perfectly illustrates the company's commitment. I mean, think about the two biggest economic meltdowns of our lifetimes. During the great financial crisis back in 2008, when so many other companies were slashing their dividends just to survive, Target raised theirs. Then, during the absolute peak of uncertainty in the 2020 pandemic, they did it again. That is just a powerful statement about their promise to shareholders. All right, let's put all these pieces together. Let's wrap this up and get to our final verdict. We've looked at safety, we've looked at growth, and we've seen how it holds up under some serious pressure. So the bottom line is, when you just look at the numbers, the conclusion is pretty darn clear. Target's dividend is a bullseye. It is safe with a really conservative payout ratio that's backed up by strong cash flow. It's growing with an absolutely elite 53-year streak of increases, and maybe most importantly, it's incredibly resilient, having been tested by fire through the worst economic crises of the modern era. If you want to go deeper and understand the full business model behind these numbers, check out our full-length analyses on our main channel, Synaptic Investing. And of course, if you found this breakdown helpful, a like is always appreciated, and subscribe for more dividend analyses. Thanks for watching.